Welcome to this video on the global market implications of the US-Israel-Iran campaign. We'll be reviewing the weekend situation report and Monday market outlook. The executive summary details the geopolitical event, supply chain shock, and market reaction. This includes a massive risk-off rotation, with equities tumbling and safe havens surging. Monday's market playbook shows safe havens like Brent crude, gold, and US dollar appreciating. Risk assets like the S&P 500, global equities, and aviation and travel are tumbling. Gulf markets are suspended or hit. The geopolitical catalyst was Operation Epic Fury, a joint US-Israel strike from February 28th to March 1st. It involved over 2,000 airstrikes and sorties, resulting in the confirmed death of Supreme Leader Khamenei. The contagion map illustrates regional retaliation, with Iran launching around 300 missiles and drones at 8 regional nations. Fatalities and damage are confirmed in Israel, Kuwait, and the UAE. The Strait of Hormuz is the primary transmission mechanism, threatening full closure. This critical energy artery sees 25 to 30% of daily seaborne oil flow and 20% of global LNG trade at risk. Marine war insurance rates have spiked by 25 to 50%. The oil shock tiers the disruption pricing. Tier 1 is the immediate $74 to $80 per barrel baseline. Tier 2, sustained closure, is $100 to $120. The worst-case Tier 3, involving destruction of refinery infrastructure, is over $120 per barrel. Supply-side constraints show that OPEC Plus cannot offset the shock in the short term. The agreed increase is only 206,000 barrels per day, far less than the 14 million plus barrels per day trapped if the Strait of Hormuz closes. Logistics and supply chain paralysis include over 1,500 flight cancellations globally and the shutdown of Dubai Airport. Maritime halts involve DP World suspending operations at Jebel Ali port and MSC halting all bookings for Middle East cargo. The macro threat is a potential 1970s-style inflationary shock. Surging oil and shipping costs accelerate global inflation, forcing central banks to pause cuts or raise rates, putting pressure on net energy importers. The equity rotation shows gold versus the S&P 500 ratio has broken its critical 0.60 neckline. Investors are aggressively shifting capital out of growth-sensitive equities into inflation hedges. The strategic outlook presents two forward scenarios. Path A is de-escalation and stabilization, where the conflict remains localized. Path B is escalation and recession, where energy prices surpass $120 per barrel, triggering a global recessionary environment. As the first trading week of March 2026 unfolds, the analysis identifies 4 critical areas for monitoring. First is the Strait of Hormuz traffic. The status of the 200-plus anchored vessels and the marine insurance rate volatility will be the first signs of whether the blockade is temporary or structural. If insurers continue to issue cancellation notices, the supply chain for 20% of the world's oil remains effectively, quote, dead in the water. Second is the Gulf market reopenings. When the suspended UAE and Kuwait stock exchanges reopen, the scale of contagion selling will reveal the true extent of regional capital flight. Third is the Iranian succession. The stability of the Temporary Leadership Council, particularly the roles of Ali Larijani and Ali Reza Arafi, will dictate Tehran's retaliatory posture. Finally, monitor Washington's response. Any war powers vote in Congress or further regime change rhetoric from the White House will signal the duration and intensity of the campaign. In conclusion, the events of February 28, 2026 have shattered the illusion of a low-volatility global market. The epic fury of the US-Israel strikes has triggered a chain reaction that weaponizes global choke points and forces a violent rotation into safety. Whether this represents a generational buying opportunity or the beginning of a stagflationary depression depends entirely on the missile math of the coming days and the resilience of the global supply chain architecture. The playbook is clear: protect margins, hedge for inflation, and monitor the strait. The convergence of Operation Epic Fury and the subsequent regional retaliation has created a, quote, perfect storm for the global economy. The analysis suggests that we have moved beyond the era of just-in-time efficiency into an era of just-in-case survivalism. The 10,000-word reality of this conflict is that it targets the connective tissue of the world: energy at Hormuz, logistics at Jebel Ali, and finance in the S&P 500. The technical break in the gold to S&P 500 ratio above 0.60 is the most durable signal of this change, suggesting that the decade of equity dominance may be yielding to a decade of hard assets. As central banks lose their ability to cut rates due to energy-driven inflation, the complacency that defined 2025 has been replaced by the epic fury of a new geopolitical reality. The global market is not just reacting to a strike, it is pricing in the end of the post-Cold War stability. Investors must now navigate a landscape where the standard geopolitical playbook is being rewritten in real time by hypersonic missiles and decapitated regimes.